welcome to the FinGlimpse podcast, where we analyze the world of business, finance, and the economy. We cover the latest market news, economic trends, and some interesting businesses. As a standard disclaimer, this podcast is for informational purposes only and should not be considered investment advice. Always do your own research. Now, let's get started.
All right, welcome to the Deep Dive. Today, we're jumping into the latest economic signals coming out of China. We're looking at a recent analysis of their Purchasing Managers Index data for May 2025.
That's right. We've got this report here, and, well, the plan is to really unpack these numbers. What are the underlying trends, any surprises, and, what's it telling us about where the Chinese economy is right now? What should you be keeping an eye on?
Exactly. So let's start with the big one, the headline manufacturing number.
Okay, so the main figure, the manufacturing PMI for May 2025, this analysis has it at 49.5%.
Right, 49.5. And just as a quick reminder for you listening, the PMI, the Purchasing Managers Index, it's a key indicator. Surveys businesses about things like orders, production, jobs.
Yeah, inventories too. And that 50% mark, that's kind of the crucial line. Above 50 signals expansion compared to the month before. Below 50 means contraction.
Oh.
So 49.5, still technically contracting.
Still contracting, yeah. But the analysis does note it was up half a percentage point from April. So
Yeah.
a small step up. A marginal recovery, I think they called it.
It is marginal, yeah. But what's quite interesting is that small increase actually slightly outperformed the usual seasonal pattern you'd expect for May, looking back over the last 3 years. So while it's still contracting, maybe not quite as weak as May sometimes is.
Okay, that's an important nuance. So even that slight improvement, what was behind it? What drove that little nudge upwards?
Well, the data seems to point pretty clearly towards one main driver, some temporary relief in tariff tensions. That apparently coincided with a bit of an export rush. So external demand picked up, and that pulled supply along with it.
Ah, okay. And you can really see that if you dig into the specifics, the sub-indexes.
Absolutely. Look at the production index itself that was actually above 50, came in at 50.7%. So factories were churning out more stuff in May.
But where were the orders coming from?
That's the key contrast. The new export orders index saw a pretty significant jump. It rose 2.8 percentage points compared to April, hitting 47.5%. Now, still below 50, but that increase is highlighted as having, quote, supported related supply.
Right, a decent jump on the export side. But how does that compare to the overall new order index, the one that includes domestic demand?
Well, that's where you see the weakness. That index only showed a modest recovery. It landed at 49.8%, so barely moving. It paints a picture, right? Exports providing some lift, but domestic demand is still a waiting boost, as the analysis puts it.
A waiting boost, okay.
Yeah.
And does other data back up this idea of soft domestic conditions?
It does. You look at the price indexes. The PPIRM, that's the raw material purchase price index, what businesses pay for inputs was down at 46.9%. And the PPI, the producer price index, what they charge at the factory gate, was even lower at 44.7%, both really lingering at low levels.
Low input costs, low factory gate prices. It definitely sounds like weak pricing power, probably linked to soft demand, low inflation maybe.
Exactly. It reinforces that picture. And you also see it in purchasing activity. The raw material purchase index only had a modest rebound, still subdued at 47.6%.
So they're not rushing out to buy more raw materials.
Not really. And look at inventories. Raw material stocks were hovering near the bottom at 47.4%, and perhaps even more telling, finished goods inventory actually declined down to 46.5%.
Okay, so let me get this straight. They aren't buying many inputs, their input stocks are low, and their finished goods stocks are falling.
Precisely. You put that together, and it strongly suggests that companies are still pretty cautious. They're meeting the current orders, especially those export ones, but they're not building up inventory like they expect a big surge in domestic activity anytime soon.
And it wasn't even the same story for all manufacturers, was it? The report mentioned size differences.
Yeah, good point. It breaks it down. Larger companies actually did better. Their PMI was above 50, but medium and small enterprises, still contracting, below 50. And medium-sized firms were notably lower.
Wow.
So it's quite an uneven picture, even just within manufacturing.
Okay, so beyond the overall number and company size, what about different types of manufacturing? Did the report show divergence there too?
Oh, definitely. Big differences across sectors.
So which parts were doing better? Where was the strength?
Well, certain areas were clearly in expansion territory and showing better activity. You had high-tech manufacturing at 50.9, equipment manufacturing slightly higher at 51.2, and consumer goods manufacturing also just above the line at 50.2. Those seem to be the brighter spots.
And the weaker areas.
On the flip side, energy-intensive sectors, they showed lower activity. Their index dipped down to 47.0%. So yeah, a definite split.
And the report even got more specific, right? Mentioning particular industries.
It did. It highlighted some seeing rapid growth in both supply and demand, things like agricultural and sideline food processing, specialized equipment manufacturing, and also railway, shipbuilding, and aerospace equipment.
Okay. And the ones lagging?
Those included sectors like textiles, chemical fibers, and also metal smelting and processing. They were showing insufficient growth. So it's really not a case of all manufacturing rising or falling together. Very patchy.
Okay, let's switch gears then. Away from the factories, what about the rest of the economy? Services, construction. What did the non-manufacturing PMI look like in May?
Right. So non-manufacturing, the services sector showed pretty steady performance. Its business activity index was 50.2%. That was only up like zero point 0.1 percentage points from April, basically flat. But that actually lines up pretty well with the normal seasonal pattern for May.
So just holding steady. What kept it there?
The analysis points to a couple of things. Travel-related sectors, think rail, air travel, hotels, restaurants, they were described as relatively vibrant, probably got a lift from the May Day holiday period, you know?
Ah, the holiday effect. Makes sense.
Yeah. And also, some of the more modern service sectors continued to do well. Things like postal services, telecoms, IT services, those remain in high prosperity territory, staying above 55.0.
Okay, so services looking fairly stable, helps by holidays and tech. What about construction?
Construction was a bit different. Its activity index actually saw a marginal decline. It slipped 0.9 percentage points down to 51.0%. Now, the report notes this also kind of fits seasonal patterns sometimes, but the overall performance was still described as a waiting boost.
A waiting boost again. That sounds familiar from the domestic demand side of manufacturing. But wasn't there a big split within construction itself?
Absolutely. And this is, I think, a really crucial point in the report. There's a major divergence. One part of construction is actually booming.
Which part?
Civil engineering. So think infrastructure projects, roads, bridges, that sort of thing. Its activity index has been rising and hit a very strong 62.3% in May.
62.3, that's really high. What's driving that?
The report is pretty clear on this. It links it directly to accelerated fiscal policy implementation. Basically, the government speeding up spending on infrastructure, pushing out money from things like special bonds and those ultra-long special treasury bonds faster. Public spending is clearly propping up this part of construction.
So government projects are powering ahead. But what about the other big piece of construction real estate?
Right, and that's the other side of the coin. The analysis points out that while the secondhand housing market was pretty active in the first quarter, those transactions started to decline in Q2.
Okay. And what does that imply?
Well, according to this report, that slowdown suggests potential downward pressure on overall construction activity going forward, coming from the real estate side.
And the report flags this specifically, doesn't it? As something needing close monitoring.
It does. So you've got this real contrast. Government infrastructure spending pushing one part way up, while the private real estate side looks like it could be a drag. That divergence is definitely one of the key takeaways.
So this analysis seems to suggest the focus is shifting a bit, maybe away from external factors.
Yeah, it makes that point quite strongly. It argues that the direct impact of external factors, like trade friction, seems to be lessening. It highlights the resilience of China's manufacturing competitiveness and basically concludes that, external factors are not that crucial for the medium to long-term picture.
Which puts the spotlight firmly back on domestic issues.
Exactly. The report states very clearly that the key challenge, the central thing they need to fix, lies in resolving domestic low inflation issues. That weakness in domestic demand, that's the core problem they need to tackle now.
Okay, so if that's the problem, what does the report say about the policy response? What are they doing?
Well, on the monetary policy side, it's described as remaining steady and accommodative. Supportive, but maybe not dramatically changing course.
And fiscal policy, like the government spending.
That seems to be where the main action is, or at least the focus. The primary approach right now is described as accelerated implementation pace. So basically speeding up the spending that was already in the pipeline, getting the money out the door faster.
Just spending the planned money quicker. Is there talk of more spending?
The report does hint at the potential for additional reinforcement if things don't pick up enough, and it suggests where that extra fiscal push might go in the short term.
Where's that?
Two main areas mentioned. First, investment expansion, but maybe more targeted this time,
Uh-huh.
focusing on urban renewal projects, things like upgrading city infrastructure, renovating older housing communities, villages, streets, kind of smaller scale stuff.
Okay, targeted investment. What's the second area?
The other focus is consumption promotion, trying to get households to spend more. The report mentions potentially strengthening national subsidy policies as one way to do that.
Right, so maybe more direct support for consumers. So if we bring all this together, the analysis suggests the narrative is shifting, wouldn't you say? Less about trade wars, more about fixing low domestic demand and inflation.
I think that's a fair summary of the report's perspective, yeah. And the main risks it highlights kind of reflect that too. It still mentions disruptions of external factors as a risk, but it pairs that directly with real estate demand shifts. Both external stability and, crucially, internal demand recovery are the things to watch.
Ah, okay, so let's make this concrete for you listening. Why wade through all these PMI details? Why does this matter?
Well, because these numbers, they give you a pretty timely snapshot of what's actually happening on the ground in the world's second largest economy. You see activity levels in manufacturing, services, construction.
Kind of shows you the different speeds things are moving at, right? Like how exports seem to be bouncing back faster than domestic spending right now. You can also see where policy is having a direct effect, like with that big boost to civil engineering from government spending.
Exactly. And it points you straight to the potential trouble spots that analysts are watching closely, that persistent low inflation, the potential wobbles in the real estate sector.
Yeah, this isn't just, abstract economic data. It reflects real activity. It impacts global supply chains, specific industries you might invest in or follow, and just broader global economic momentum. Understanding these details gives you a much clearer picture than just reading a headline number.
So, to wrap up this deep dive into the May PMI analysis, it shows a pretty nuanced picture. You've got manufacturing staging a very marginal recovery, but it seems quite dependent on that external export demand, while domestic orders remain weak. Services held steady, helped by holidays and tech. Construction is really a tale of two sectors. Public infrastructure booming thanks to policy, but real estate facing potential headwinds.
And the central challenge, as this report frames it, is really about boosting that internal domestic demand and shaking off low inflation. Policy seems focused on pushing out existing fiscal spending faster, maybe adding more targeted investment in urban areas, and potentially looking at ways to boost consumption through subsidies.
Which leaves us with a final thought, maybe something for you to chew on. If this analysis is right, and the core challenge is firing up domestic demand to tackle low inflation, and the main policy levers being pulled are accelerated fiscal spending, urban renewal, and potential consumer subsidies. What would actually be the most effective catalyst? What could really ignite household and business spending in a sustainable way, moving China away from this reliance on exports and state-led infrastructure?
Yeah, what specific signs, maybe beyond just the headline PMI, would you be looking for in the coming months to see if that crucial shift towards stronger domestic demand is actually happening?
Something to consider.
Definitely something to think about. Thanks for joining us for this deep dive.
That's all for this episode of the FinGlimpse podcast. If you found our discussion insightful, please consider subscribing and leaving a review. We'd love to hear your thoughts and suggestions for future topics. Until next time, stay informed and make smart decisions. Goodbye.